Happy Friday, guys. Good to see you both. Darrell, let me begin with you. Sounds like you're not in the mood to buy in aggregate. You know, Fed, you argue, remains a bit hawkish here. Valuations have not yet become cheap in your view.
Yeah, I think that's right, Carl. They're obviously cheaper, but, you know, it's interesting if you look at things like equity risk premiums. We're still lower today on equity risk premiums than we were at the June lows or the October lows. So we still think as the Fed finishes this tightening cycle, 50 next week, we actually think they'll probably do 50 in February and maybe 25 in March, which puts the terminal rate at 5%, that you probably have a little better buying opportunities in the first quarter of the year. We're getting much closer. You know, bear markets are a function of price and time. We dropped into this bear in mid-June. Typical bear lasts about 290 to 300 days. So first quarter would be very consistent with what history gives us.
Interesting. John, how about you? I wonder what you make of this early December weakness. Do you think this is sort of the historical first half is a lot of tax loss selling before Santa finally arrives?
I think in part, Carl, it most certainly is. I'd also say that, you know, the market is in the middle of a real Fed funds hike cycle. And it's very much watching these numbers, whether it was the PPI today or the CPI next week. The sentiment number from University of Michigan in terms of the consumer, all of this, it creates a period of volatility, which we think actually offers opportunity for investors to catch some babies that get thrown out with the bathwater.
Darrell, I want to drill in a little bit to the valuation point that you were making there, which is, you know, clearly, you know, the market has not become cheap on the index level. You mentioned the equity risk premium. So this is, you know, the earnings yield of the S&P subtracting the treasury yield from it or some other bond yield. In other words, it's a stock versus bond equation. And you say stocks are more expensive relative to bonds than they have been, I guess, since the 2010s or since the global financial crisis, maybe since 2000. But when rates were higher before 2000, equity valuations were higher than they are now. In other words, it seems like it matters what the absolute level of rates are as opposed to just the difference between those two things. Is there any reason to think there's a fixed relationship there?
No, you're 100% right, Mike. And the issue with equity risk premium is we think it's a better valuation tool than traditional price earnings because you're just looking at the price of the index, you know, divided by the earnings. Equity risk premium will take your earnings yield less we use 10-year treasury. So today it's about 170 basis points. Over the last decade, it's run 300, 350, 400 basis points. What that tells you is when it's below 200 is you're not getting a great risk-reward trade-off for equity valuations with where interest rates are. Because as you know, investments are ever and always a trade-off. You know, do I bank left or bank right? So equity risk premium, we think, does a better job of understanding when do I get paid to take that risk. We do think we'll get there again in the first quarter, but we think things are going to cheapen before they actually start to move higher and make that next leg higher. Conditions are still tightening. It's not just the Fed increasing interest rates. It's QT. It's the dollar up 15% year over year. The M2 money growth has dropped negative from running 27% positive. And we've drained about $1 trillion off of bank reserves, which is tightening financial conditions too. All of that has to play its way out in Q1.